1 month costs Dave about $19,500. Do you know which part of your own capital gain would actually be taxed? We'll pull apart the whole machine, then close with the exact 12-month calculation and what could change next. First, the core mechanism. There is no separate capital gains tax rate. For a straightforward sale, the gain generally starts with capital proceeds minus the asset's cost base. Apply current and carried forward capital losses, then any eligible discount and concessions. The resulting net capital gain is included in assessable income and taxed under ordinary income tax rates. A CGT event can be a sale of shares, investment property, or crypto. But not every CGT event is a sale. Sell something big and taxable income for that year can jump. That is the machine. Everything else changes what reaches the final net gain. That is the machine. Now the cost base, remember Dave, our investor from the negative gearing episode? Years on, Dave is selling that property. He bought it for $600,000. He's selling for $750,000, but his gain isn't automatically $150,000 because eligible costs can join the cost base. Stamp duty when he bought, agents' fees and legal costs when he sold, capital improvements like the new kitchen, provided they are not already claimed elsewhere. Every eligible dollar in the cost base can shrink the capital gain, which is why the most boring tax habit can be the most valuable. Keep the records. Dave's shoebox of paperwork may save him thousands. First payoff, the current 12-month rule behind that number. An Australian resident individual can generally reduce an eligible capital gain by 50% after owning the asset for at least 12 months under the ATO's counting rules. Take Dave, an $85,000 salary and a clean $100,000 gain with no capital losses, other deductions, concessions, offsets, or Medicare Levy surcharge. Without the discount, the incremental income tax plus a full 2% Medicare levy is approximately $35,500. With the discount, only $50,000 enters the calculation, and the increment is approximately $16,000. The illustrative difference is $19,500. If that difference surprised you, the like genuinely helps this reach people who still think CGT has one flat rate. That closes the 12-month calculation. Next, the biggest exemption. A qualifying main residence is generally fully exempt from capital gains tax, and the 2026 reforms do not remove that exemption. But the conditions matter. Australian tax residency, use as the home across the relevant ownership period, no disqualifying income-producing use, and generally no more than 2 hectares of land. Renting it out, using part for business, periods when it was not your home, larger land holdings or foreign residency rules can reduce or remove the exemption. Check the ATO's main residence guidance for your facts. That is the home exemption. Now, how the system got here. Capital gains tax began for assets acquired from the 20th of September 1985. The original regime broadly indexed eligible cost bases for inflation. alongside averaging rules. In 1999, indexation was frozen, and the 50% discount became the main method for eligible individuals and trusts. A legacy choice between frozen indexation and the discount still exists for some assets acquired before the 21st of September 1999, but you cannot use both. Legislation passed in June 2026 introduces new CPI indexation rules for eligible CGT events from the 1st of July 2027. That is the history. Now, the next machine enacted law, not just a budget announcement. From the 1st of July 2027, eligible post-change gains of Australian resident individuals and relevant trust or partnership investors will generally use CPI cost-based indexation instead of the 50% discount, subject to the 12-month and entity rules. For covered resident individual gains, a 30% minimum income tax mechanism can top up basic tax before offsets. Exceptions include qualifying new residential and affordable housing, certain income support recipients, and entities outside the new indexation regime. Assets held across the date are split using a 1st of July market value or a permitted apportionment method with tax deferred until disposal. Pre-CGT appreciation remains protected. You know, one person with old shares or an investment property, send them this explanation before they act on a headline. Why change a system that stood for a generation? Both sides deserve a fair hearing. The government argues the old discount could tax eligible investment gains more lightly than additional labor income, while new indexation targets inflation and the minimum calculation reduces the benefit of realizing covered gains in a low-income year. Critics, including Business New South Wales and CPA Australia, argue some investors and business owners may face higher effective tax or more complex valuations and split calculations. Although the 4 existing small business CGT concessions remain unchanged. Both arguments are serious. Parliament made its call. We are not here to referee it, just to explain the mechanism. Do you know which part of your own capital gain would actually be taxed? Before this video, did you check? Was your answer yes or no? Put that in the comments. We have heard both sides. Final practical payoff. 4 things. 1. Keep records like they are money. Purchase costs, eligible incidental costs, and capital improvements can affect the cost base. 2. Know the 12-month line under the rules applying to your CGT event. 3. Remember the main residence exemption has conditions. Renting or income-producing use can change the result. 4. If a large asset and the 2027 transition affect a real decision, use a registered tax agent. Do not rush a sale from a headline. Save this checklist for the year you plan to sell an asset. That is the practical checklist. Capital gains tax is not a separate flat tax. A net capital gain feeds into assessable income after the cost base, loss, exemption, discount, and concession rules. For nearly 3 decades, the 50% discount has made a large difference for eligible long-held assets. From July 2027, covered post-change gains generally move to CPI indexation, with transition rules and a 30% minimum tax mechanism. A qualifying main residence remains exempt under existing rules. Pre-change appreciation keeps its existing treatment, the discount where eligible, or the pre-CGT exemption where applicable. General information only, not tax or investment advice. For a real decision, use current ATO guidance and a registered tax agent. Watch next, Medicare Levy actually explained. Because the levy changes the tax calculation that turns a capital gain into a final bill. New video every Tuesday. Subscribe for the next Australian money system breakdown.